Tesla received its third downgrade this morning. I'm going to tell you why that is a good thing, and I'm also going to show you on the charts why that was predictable. So this morning we got a headline from Morgan Stanley. They downgraded the stock. This is on top of a downgrade by Barclays yesterday. Let's look at the video from CNBC.
Great. Thanks for having me, Kelly.
So let's start. These are always tricky when it's, near-term challenges, but you raise a price target, long-term opportunity. How do you thread the needle on this one?
Yeah, listen, we've been bullish on Tesla. We see them as a long-term winner in the industry's transition to an EV world. We acknowledge that there's more to Tesla than just the automotive story. And even from a more, call it midterm catalyst path, you have Model 2, the push to mass scale coming late 2024. But I think the view on the stock was that there is still a more challenging near-term fundamental setup as far as finding the floor and margins. Inventories for Model 3 are still somewhat elevated. There is still some concern that you're going to have further price cuts. And with the run in the stock, we thought that the stock was dismissing some of those fundamentals, hence the move to the sidelines.
Is there a glut of Teslas right now?
There is certainly, based on some of the data that we've seen, there is elevated inventory, especially for Model 3. I think the concern is that you have on top of this capacity ramping at some of their other facilities, Austin and Berlin, and that as more of this capacity comes online and you've seen competition from other automakers, this could spur further discounts and price cuts from Tesla.
Right, exactly. So the shares are down 5% today. Do you think they can hang on to the doubling that they've seen year to date?
Our view on the stock going forward is we fully recognize that there are other non-automotive components to the story. We appreciate that the stock is getting a bit of an AI bid. And, the opportunity near term is that you may potentially see a bottoming of margins on the second quarter. We think that as far as deliveries go, you're going to get the deliveries release in the next week and a half. We're actually somewhat ahead of consensus on that. But again, I think that, it's important to be mindful of the fundamental setup, especially as it relates to margins.
Yeah, and what about the valuation, 75 times forward earnings or something like that? You're raising your price target to 260 above levels from here. What are you valuing the shares on?
Yeah, our valuation is based on our long-term 2030 outlook. We think that by then Tesla can be comfortably north of 6 million units. That makes them the number, call it 5 or 6 automaker globally. We have them holding some margins. And then what we're trying to do is embed some upside optionality in there. So we feel that the valuation is mindful of, the path that they're going toward with some upside optionality as well, which we think is quite necessary. But at the same time, if you look at the trading multiple, this was a stock that was trading at just under 30 times EV to EBITDA as recently as late April. A lot of the feedback we got was that the 1Q earnings call was quite negative. And in the span of the last 6-7 weeks, it's gone to well over 40 times EBITDA, really off of sentiment with little in the way of change fundamentals. This is actually a sharp contrast to some of the other AI names we've seen, like NVIDIA, where you've actually seen multiple re-rating alongside positive earnings revisions.
Right, exactly, and that's a great point. You mentioned that AI has been, to some extent, a driver of the stock, but there seems to be a lot more risk around Tesla's use of it, specifically its full self-driving capabilities, where it seems like marketplace demand is not that strong right now, based on some of the prices of used Teslas that come with that equipment, where they're really not getting much of a valuation boost from it. The consumer may not be valuing it, and more importantly, regulators may clamp down. They actually have had a pretty hands-off approach so far, but as we've seen with crypto, that might not last forever.
Yeah, the approach on FSD is actually quite different from what we've seen other automakers taking. Tesla takes essentially a brain and eyes approach. There's a lot of cameras, and then there's a computer that's doing all of this. So it's a very vision-based approach. Other automakers are trying to use other sensors, and then the push to completely full self-driving. You've seen other automakers using other sensors such as LiDAR, embracing radar, and also using maps. So it's a very different approach. We've characterized the Tesla outcome as binary. It could be a spectacular success, but it's also not very clear that it could be successful, especially as it really is a contrast to the other automakers. Near term, the uptake rates on FSD have been maybe somewhat more limited. It's more of a US story. And if you look at actually some of the third-party data stacking up Tesla's system against others, there are different reviews on where Tesla's system stands. They do have clearly an advantage. They have a lot of.
Now, before we get into the charts, where I show you why it was predictable that Tesla would get downgraded, let's go over this article from investing.com. It's Tesla loses one of its biggest street bulls as Morgan Stanley cuts rates. So Morgan Stanley analysts downgraded Tesla shares to equal weight from overweight. However, they raised their price target to 250 from prior 200, with the new target suggesting a modest downside to yesterday's closing price. The analysts have been among the most vocal Tesla bulls on the street in recent years. However, they are now stepping to the sidelines after a massive rally in Tesla shares pushed valuations to fair levels. So most recently, Tesla went on a run and it was closed up green plus 10 days in a row. While the analysts made a move, they highlighted that Morgan Stanley is not trying to call the end to the Tesla rally. Yeah, just a slight pullback because price is overextended. With the downgrade call mostly based on valuation, the analysts added that Tesla remains a must-own company in any EV portfolio. So Tesla is more than an EV play. It's really a energy battery pack play, as that portion of the business could be much bigger than the EV segment. We see continued evidence that Tesla is emerging as an industrial standard bearer for one of the greatest industrial changes we have witnessed in over a century, the electric transport and renewable energy economy. This goes well beyond supercharging deals with the likes of GM and Ford, and look for other potential areas of collaboration. Battery supply is what I was talking about, in which Elon recently made an announcement that he's going to invest in India, which is going to be huge. Operating system, FSD, etc. to follow, the analysts concluded. This is the third downgrade for Tesla stock this month after Barclays and CFRA analysts also moved to the sidelines. Okay, so let's get into the charts of Tesla, just a big picture view. We got this massive head and shoulder. Price came down, dipped into the daily buy zone at 100, and we've been off to the races. Now let's go to the daily chart. And this is what I was referring to. The price was up 13 straight days. Momentum was crazy. RSI was reached 88. So pullback was inevitable. Number one, you have price respecting this steep uptrend line. Number two, you have price roughly now $40 away from the 200-day moving average. And just scrolling back out to the weekly chart, you can see price did breach above this uptrend line. Let's go back down to the daily chart. So all in all, price is overextended. Now what would be interesting today is to see if this candle, which gapped down to find buyers, closes below this uptrend line or not. We get a close below, that means that the downside potential is going to increase. I'm looking for price to get to the roughly 230 level before resuming its upward trajectory. It would be ideal if price could get down to the $200 level, which is where the 200-day moving average is at. That would be like price getting down to the $100 level before moving up more than 100%. So let's see how price action happens over the next couple of days. But today is crucial. Again, a close below this uptrend line, look for more downside risk. But that's a great thing for people who are not in the stock or people who are in the stock and want to add to their shares. 230 is the level that I'm looking at, with a target eventually at 300. Thanks for watching. Subscribe. Please like the video.